A world in which rates did not rise is probably a world in which our stocks would have done very, very well. So it has the benefit of cushioning the downside. I think the discount is largely driven by the relatively small universe of people relative to kind of general investors in the market that buy closed-end funds. Mm-hmm. And as we're the second largest closed-end fund in the world by NAV, and the universe of people who can own us, therefore, and we also outperformed dramatically in the last 5 years, and so we've outgrown, in some sense, the traditional buyers of closed-end funds.
Star investor Bill Ackman gazes into his crystal ball and makes some predictions about inflation, interest rates, and Federal Reserve policy. He is the founder and CEO of Pershing Square Capital Management, a company that manages hedge funds. Before proceeding further in this video, please make sure to click on the subscribe button below to stay updated with our latest content. Bill Ackman believes markets could have a better time in 2023. Bill says, predicting the market in the short term is a sucker's game, but believes the later part of next year could be when stocks pick up. In a series of exclusive interviews with Shares editor Daniel Coatsworth, Ackman outlined his belief U.S. interest rates could hit 5% in the short term and stay around that level for most of 2023.
I think the Federal Reserve, I think people understand, is going to continue to raise rates. Getting to something approaching a 5% short-term Fed funds rate, and that rate staying there for an extended period of time, i.e. probably most of 2023. So there's not any subsidy, if you will, to the markets coming from the Federal Reserve. There's basically the opposite. And that, of course, will also be, it's already having the effect of restraining the economy and hopefully inflation. I think once the market starts to see inflation taper, and if inflation tapers pretty quickly, they can begin to predict that the Federal Reserve is going to take its foot off the brake a bit and perhaps start taking down rates. I think that will be a perceived and probably likely buying opportunity. So I think that's a potential catalyst more toward the end of 2023 for markets to, people starting to getting excited about owning equities again.
Ackman added that he didn't think the Fed could get inflation back to 2% without a deep, job-destroying recession. He said that accepting inflation around 3% is a better strategy for a strong economy and job growth over the long term. Bill Ackman says digitization of music made it easy to pirate and more convenient to steal music than go to a record store and buy music. That almost killed the industry. According to Ackman, Spotify launched, and that led to the recovery of the music business, and streaming has become more than half of music industry revenues. Universal is the dominant player with a third of global music market share.
The value of a business, unless it's a highly levered, very economically sensitive company, is not particularly affected by the by the event of a recession. Right? If you own the value of a stock, right, the value of an interest in a company is the present value of the cash that business generates over its life. And if it's a business that should exist forever, well, pick Hilton, for example, we can expect that in past history, there's been a recession every 7 or 8 years. Let's assume the future is the same, and there's a recession every 7 or 8 years going forward. That's kind of factored into the value of the enterprise. The only reason why a recession destroys value is if you have a company that is highly levered, and then if revenues decline, their cash flow goes negative and they can't support their debt and they go bankrupt, right? But if you own a very well capitalized business, I don't think a recession has a meaningful impact. It might affect that year's revenues and cash flow, but that's just one line item in a long spreadsheet of cash flows that you discount, if you will, into the present. But the businesses we own, Universal Music being the largest one, and a good example, people are not going to, we think, cancel their Apple Music subscription because we're in a recession. It's the cheapest form of entertainment. It's 10 cents an hour or something like this. Compare that to a movie or a video game, and you pay a lot more.
Bill Ackman's Pershing Square is Chipotle Mexican Grill largest investor with a $1.6 billion stake that comes via 1.1 million shares. Pershing Square Holdings instead took a direct stake in Universal Music, and it is this investment which has helped to revive the investment company's share price in recent months. Ackman insists that predicting short-term market movements is a fool's game and is not something we do. But ultimately, he says Pershing Square Holdings' core strategy is about owning super durable, undisruptible companies. According to Bill Ackman, Pershing Square Holdings has held up relatively well with a mere 2% year-to-date share price decline versus a 17% decline in the S&P 500 and a 28% slump in the NASDAQ. However, its shares trade on a 31% discount to net asset value, much to the frustration of the manager.
So we've actually made a lot of money on our hedges. So we spend a small amount of capital on investments that have option-like payoffs, and many of them are actually options themselves, not inherently particularly complicated, but a bet on interest rates rising, for example. So a couple of those bets have led to large profits for us this year. We've invested a little under $400 million, and that's turned into about $2.8 billion system-wide. Some of that profit was unrealized last year, accrued into our results last year, and the bulk of it has been realized this year. And those have been some very successful hedges, and we're doing more of that. It's something we've done over a long period of time, opportunistically, and I would say inherent volatility, uncertainty of the world has made a number of those hedges both good hedges and also interesting standalone investments. So anytime you can hedge the portfolio, so for example, we thought rates would rise a lot, and we hedged rates by buying so-called interest rate swaptions. It helped offset some of the mark-to-market losses we've suffered on the long side of the portfolio, but it's also, on a standalone basis, a good investment, and those are the best hedges, ones where you don't mind making a big profit on the hedge, even if your stocks go down, because we think the businesses we own will do fine and recover over time. And in fact, our companies have actually reported quite good results. And so what we've seen is more a reduction in the multiples people are paying for businesses, really no real impact on the underlying companies themselves, at least for our portfolio.
During his recent interview with A.J. Bell, Bill Ackman explained why investors should focus on super durable growth companies in this market. What is your outlook for 2023 and the ongoing inflation and recession in market? Let us know in the comment section below. Our conversation for today has reached its conclusion. If you found this content useful, please consider liking this video and subscribe to our channel. See you with another update.